Recession next year or no?
No, you kidding me? I'm not worried about a boom over here.
Happy Friday and welcome back to Real Estate Mindset. You guys already know this video is going to be absolutely bonkers. Despite Cramer not being worried, we can't say the same thing about Goldman Sachs, Morgan Stanley, the IMF, and the Federal Reserve, as they're now issuing further warnings to you and to I, stating the market's going to crash. The market was always going to crash. It's a healthy part of the economy, and expect the market to crash. And oh, by the way, the end of this video is going to be about how the economy in certain sections of the economy is already in recession. Goldman Sachs, Morgan Stanley warn of a market correction. Things run and then they pull back. We all know that, right? By now? Comment below. Let me know if you know that. And all I want you to do is just comment stock crash if you know things go up, and the big thing here, down. People forget the down part. Goldman Sachs and Morgan Stanley expect a 10 to 20% correction in equity markets over the next 1 to 2 years, as well as IMF, Fed Chair Powell, and the Bank of England Governor Bailey have warned of overvalued equities. Global markets may be due for a reality check after this year's relentless rally, as Goldman Sachs and Morgan Stanley on Tuesday cautioned investors to brace for a drawdown over the next 2 years, driven by AI-linked gains. Okay, big AI bubble right now, and expectations of rate cuts. It's likely that there's going to be a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months, and that's according to Goldman Sachs. And again, they're saying things run and then they pull back so people can reassess. Solomon noted a 10 to 20% drawdown happens often, even through positive market cycles. It's not something that changes your fundamental, your structural belief as to how you want to allocate capital. Now, Morgan Stanley, speaking at the same panel, said investors should welcome periodic pullbacks, calling them a healthy development rather than signs of a crisis. But we haven't had any of those signs, so it's probably going to be a crisis because the market's been so incredibly unhealthy. It's been going up pretty much this whole time. We should also welcome the possibility that there would be drawdowns of 10 to 15% that are not driven by some sort of macro cliff effect. Very interesting stuff. Dow, S&P, and NASDAQ fall with tech on track for worst week since April. Anxiety over government shutdown pushes consumer sentiment down to near record level low. Now, as far as how Michael Burry is doing shorting the market, as you guys can see here, Palantir rebounded today, but over a 5-day period of time, this stock is down 12.2%. And you guys remember, he bet about $1 billion against the stock market. Now, what's interesting about Palantir, insider trading has come to light from the director of Palantir, and he has sold roughly about $6 million of stock. And that was November 3rd, around the same time that we found out about Michael Burry. First, to the viewers, Mitch has no idea about what I'm about to ask him. And I like to keep it that way because I like to see you fresh on your feet, Mitch. We've been working together for a while. Based on everything that we went over just in this week alone, the derivatives market, the job market, the layoffs, the economy, the recession, the indicators, all of that type of stuff, do you think that these warnings from Goldman Sachs, JP Morgan, of a 20% correction, do you think that that's kind of ridiculous because it's too low? In other words, Mitch, do you expect a crash in the stock market that exceeds 20%? And can you please illuminate why or why not?
It's interesting that markets are made of people and people have different opinions. So when you listen to Mr. Cramer snorting in derision that what recession? Well, that would beg the question, Mr. Cramer, is one man's recession another man's depression? And how do you explain the position of somebody whose home is being foreclosed upon due to a tax lien foreclosure? Are they not, by definition, in a depression? And to answer the question specifically, because there's different markets at play, mama pop, that's one market via median household income. Short-term trading, long-term trading, options on futures, 401ks, pensions, these are all elements of different markets. Well, if you look at the markets themselves, and you say many of these markets are in stress. Why are they in stress? Well, the Federal Reserve prints money, and the ramification of printing that money is a market that's just coming off of an all-time high. However, technically speaking, another market, shorter term basis, yes, you will get a pullback. And in my humble opinion, for what it's worth, it will blow past 20%. And that's because on a technical basis, if you go low to high of the last pullback, you typically end up somewhere between a 50% and a 0.618% pullback, which is a Fibonacci ratio. Now, it takes time to get there. It doesn't happen overnight. But as I said, Michael Burry was 100% right, and we called it. We literally said this was coming, and we were 2 days early. So that's what happens. You have to be prepared for these things. These moves occur, and this was a big move. And this is almost 10% in 5 days for NASDAQ. Big move.
Yeah. And for the viewers that have been following along, trying to figure out how to trade the markets, you guys, first of all, you guys already know I hate it. If I could choose, Mitch knows this, and I will say this to anyone, I would just get rid of the stock market. I absolutely hate it. And I think if you've been following me, you know exactly why that is. But nevertheless, maybe within the next month, we're going to start potentially doing lives in the morning, showing you guys how Mitch is playing the market. So I may take like, I don't know, $1,000. We may go live 3 times a week and kind of just see how that's working. And do me a favor, guys, if that's something that you want to learn, if you want to see by example how to play the market with volatility like is happening right now, you guys got to do me a favor and comment below stock market. So I know that that's something that you guys want to be a part of. Okay, so comment below stock market. Now I'm going to move on. The next segment is going to be especially important because the SEC has started an investigation on a credit rating agency, or rather a debt rating agency that could potentially impact $6 trillion worth of debt. You guys, this is huge news. This came out yesterday. I almost made a video in the middle of the night because I wanted to get you guys this info because we've been covering this. Remember, you guys, Tricolor went bankrupt on billions of dollars in bond debt that were rated AA, meaning there should have been like no risk. And lo and behold, it went bankrupt. The SEC is probing Egan-Jones over its private credit rating practices. For once, the SEC perhaps having finally learned its lesson from the global financial crisis. No, they didn't. Or simply because it read one too many critical pieces in the press in recent weeks. It's not waiting until the credit bubble burst to warn the raters not to engage in rating shopping. Bloomberg, which was the first to highlight Egan-Jones's role in rating thousands of credit ratings in the multi-trillion-dollar private credit market, now reports that the Securities and Exchange Commission has been scrutinizing Egan-Jones ratings, delving into the business practices of a leader in the fast-growing market for private credit ratings. Now, according to the report, the SEC enforcement attorneys are looking into whether the firm and some of its senior executives have exerted improper commercial influence. That's horrible. Handful of people, ruin it for everyone. On its ratings procedures, said the people who asked not to be identified discussing the ongoing probe. Egan-Jones is a nationally recognized statistical rating organization which allows its grades to be used by U.S. insurers to calculate their regulatory capital charges. A higher rating means an issuer has to set aside less against an asset. This is so important to understanding the debauchery in the leverage markets. Egan-Jones built a dominant position earlier in the rapidly expanding private credit markets. As bigger rating agencies focused on serving the larger public sectors, roughly a third of the $6 trillion of cash and invested assets held by the U.S. life insurers was allocated to various types of private credit investments. Last year, the company rated more than 3,000 private credit investments with only, think about it, 20 analysts. How can 20 analysts, okay, rate 3,000 credit investments? Think about it. You can't do that. 20 people can't accurately rate 3,000 credit investments. Absolutely insane. The Bank of England, as well as UBS and the chairman of the Federal Reserve, all warning you guys that something's going to happen. Everything was fine in their world apart from the role of rating agencies. everyone knows at this point, not only are we in a recession, everyone knows that the stock market is overvalued. People know that it's going to crash. We get that by now. And I'm pretty sure people are starting to wake up to the Ponzi scheme. And part of the big piece of that Ponzi scheme is those rating agencies. They allow the mechanism to continue to flourish under fraudulent type of pretexts. And so, Mitch, my question to you, and maybe you could illuminate this a little bit more, can you just talk about how rating agencies have absolutely failed, and rating agencies, unless they adapt to inflation, will never be able to pick up fraud? And inflation, sir, is fraud. Can you kind of go into that a little bit?
Unfortunately, history is repeating itself. The rating agencies are aiding and abetting a criminal conspiracy to defraud. And on my website is a document that I wrote. It's a PowerPoint presentation called Credit Analysis and Systemic Moral Hazard equals Terminal Failure. And inside that document, it's searchable. You can go to the website, search it, and download it. But inside that document are the mechanics that the rating agencies are supposed to use in order to rate a bond, AA, BB, what have you. The reality is that school district bonds, vast majority of them are in fact sub-junk. What is being rated as BB, B, AA is literally sub-junk. Why? Because the school district bonds are fraud. It's very easy to get there. So follow me for a second. When you have overvaluation of real estate, which causes overtaxation, and that overtaxation is then handed off in cash receipts to the school district to lever up in the form of bonds, you have at the central appraisal district level, fraud. And then by virtue of that fraud at the school district level, you have both accounting fraud and bond fraud. And the reality is that these bonds cannot be paid off because the median household income doesn't exist to do it. So what I just said in a matter of a couple of sentences, well, the rating agencies don't have it. They didn't detect it. Wait a minute, why not? How much are they getting paid for the rating agencies? How much are they getting paid to turn a cheek? By the way, history is repeating itself. Isn't that what happened with all the bonds having to do with Lehman and Enron, Wachovia, Washington Mutual? You get the point?
This has been going on, Mitch, for a while. Alan Greenspan, I'll never forget this speech, but Alan Greenspan said his one mistake was, and this had to do with the global financial crisis, was that he trusted people to do the right thing. So he's already warned decades ago the economy and the politicians and the powers that be that, hey, guys, you cannot trust these people.
It's worse than that. As we're discovering through this entire process, one must realize that the prior courts, in my cases, have recognized that fraud occurred. But what they said was it must stop, your detection must stop at the appraisal review board. Well, it can't stop at the ARB because the ARB has no capacity in law whatsoever to determine that a fraud had been committed. They also have no capacity to even understand what happens and what the requirement is under the Uniform Standards of Professional Appraisal Practice. Therefore, it's very easy to say and prove that the law itself is aiding and abetting a criminal conspiracy to defraud. They've circled the wagons around allowing the fraud to continue on mom and pop. And that's why I call this credit analysis. I mean, this is a detailed document, credit analysis and systemic moral hazard. So what Travis is referring to is the institutionalized systemic moral hazard. When the courts themselves prohibit you from getting access to the information, when the detective agencies themselves are afraid to touch something because they realize the ramifications of it, well, de facto, they're protecting the very thing that they exist to prohibit from happening. That's why this system is going to come unwound, and this time they won't be able to print their way out of it. They've blown the bubble. The debt bubble is so large that there's no math on this planet that can figure out how to pay off $5.1 trillion of outstanding fraudulent school district bond debt across the United States, $606 billion of which, give or take, is just in Texas alone. And that's only based on what we can see. We can't see the 313 agreements, not in total. We know they're there. We can't quantify it. Energy contracts, we can't quantify that. This is just based on what we can see. And when you have communities like Salina that just raised $1.5 billion with 9,000 houses, there's no math on this planet. These people just literally signed their own bankruptcy document. They're done.
So bad.
As a community, it's over.
So bad, man. And that's not counting the interest. It's actually $4 billion with the interest, and 1,400 people voted yes to pass $4 billion in ISD bond debt, to your point. Now, Mitch, before we go into our next segment talking about how certain parts of the economy is already in recession, I want to just take a step back a minute. I mean, we're always talking about how mom and pop is getting frauded here. Everyone's frauding mom and pop. Everyone gets it by now. But I want to take a step back and I want to shift gears. I want to talk about mom and pop potentially making profit. Can you tell us when you think, and I know you're not a financial advisor, so you're going to train me. Okay, so Mitch, as an expert, is going to train a rookie like me, and we'll do it live. We're not financial advisors, but I'll be the guinea pig. Mitch, when do you think that we should roll this out, and what should my initial investment be? If I want to make money in the stock market during a recession, I hear all the time that people can get rich during a recession. Mitch, I'm tired of being a servant to debt. I really want to make it. I really want to do well on the other side of this. When should we start? How much money should we start with?
Let me be extraordinarily crystal clear. Under no circumstance should anybody be trading live. You've got to get your feet wet. You have to understand what the process is. And in a couple of these videos, we mentioned a couple places where to go. Al Brooks, Dr. Al Brooks, his website, he actually has 4 books that he's written on trading, and that's from a technical perspective. And somebody wants to learn, it should be done in sim. And even in sim, it should be done as if you're trading live. So you shouldn't be able to tell the difference whether you're live or in simulation. The advantage of trading small, as in one contract, one micro, once you have a feel for it and you kind of understand what that process is and you've studied it, that's where you want to stay in perpetuity. The idea of trading large is for the Michael Burrys of the world who've been doing it for 20 or 30 years. They get it, they understand. And by the way, the amount of money he's made this week is enough to satisfy anybody for multiple generations. But you see, he made money during a recession. He went short. He timed it, he went short, and he hit it out of the park. And like I said, we called it. We knew what was going to happen because that's what the market was telling us.
Yes, but, okay, people want to know this, all right? Including me, I want to know this. When are we going to start? How much, can I do it with $1,000? Is that too much, too less? Can we do it with $1,000 as a guinea pig? Should we start first week in December? What are you thinking here? Talk to me. Talk to the viewers about when we're going to do this.
There are brokers, and you can look up Ninja. So Ninja is a broker, and they have futures, and that's what I use. And I believe you can get in with a very limited amount of money, but you never want to expose. So if you've got $5,000, you trade one micro. Basically, you want to set it up in such a way that maybe you risk 150 to make 300. That's one of the scenarios that we'll end up going through. You don't do unilateral bets that aren't based on what the market is telling you. And that's where most people fail. You have to realize that well over 90% of traders fail. They lack the patience, they lack the discipline. And that's why I'm saying don't even step to the plate unless you've got your feet wet and understand what's going on. Trade sim for a few months, 3-4 months, and truly sink yourself into the process.
Yes, but that still doesn't answer the question. So I heard $5,000. I hope I don't have to bring, so maybe I bring $5,000 to the table. That's going to hurt a little bit because I'm trying to buy a house. When should we start this, do you think?
Basically, as soon as we get cameras that are working, that we understand that people can see what we're doing. And these are very short-term trades. I want to point that out. When I trade, it really is short-term. Like I took a trade this morning. Travis called me. I was out of the trade 4 minutes later, and I was done because I know. Fridays generally are not good trading days, at least not for me. And I wait for the volatility and I wait for the setup. I've got the patience because I've been doing this for a long time and I know what the mistakes are. But it takes practice.
See, I've only made mistakes. I've only lost, actually during like the lockdowns, I lost like $30,000, never made that back. Still feel that. My wife still reminds me, she's like, Travis, don't forget what happened. And good thing I sold at that loss because I invested in Teladoc. It's not like, I don't know what it's at. It's like $5 or something. I sold it at $60 and people were making fun of me, which brings us to the last segment. Listen to the Treasury Secretary talk about how we're actually already in recession.
This week, the Fed voted to lower interest rates another quarter of a point to its lowest level in 3 years. However, the central bank's newest official, Stephen Myron, is warning that if the Fed doesn't continue to lower interest rates rapidly, the U.S. could face a recession. Do you agree that the U.S. is at risk of facing a recession?
I believe that we are in a transition period here, as we are seeing the Trump administration has cut back on government spending, Jake. What has gone unnoticed during the shutdown is for the fiscal year that ends September 30th, the government spent less than it did the year before, and because the GDP grew, the GDP, which had been 6.4, the deficit to GDP, which had been 6.4, 6.5% deficit, the highest when we weren't at war, weren't in a recession ever, we were able to bring it down to 5.9%. So we are bringing down government spending, and I would think that the Fed would want to assist with that, because if we go back and look, MIT just published a study that said 42% of the great inflation of 2022 came from excess government spending. So if we are contracting spending, then I would think inflation would be dropping. If inflation is dropping, then the Fed should be cutting rates.
But do you think that the U.S. is at risk of a recession if the Fed does not continue to drop rates?
I think that we are in good shape, but I think that there are sectors of the economy that are in recession, and the Fed has caused a lot of distributional problems with their policies. I wrote a 7,000-word essay on that. We've seen the biggest hindrance for housing here that are mortgage rates. So, if the Fed brings down mortgage rates, then they can end this housing recession. Low-end consumers who have gotten killed under President Biden, these high rates are hurting them because they have debt, not assets. Mm-hmm. So I think that there are sections of the economy that could go into recession.
Notice when he was talking about consumers, he said they have debts, not assets. And I'm pretty sure the Federal Reserve and the Treasury want to keep it that way. Mitch, it drives me crazy. They're literally saying everything except we're in a full-fledged recession. That's the only thing. I'm not saying that, yeah, there's a recession here, there's a recession there, but overall, no, we're in good shape. Mitch, why don't they just call it? Why aren't they saying, attention America, we're in recession, save your money, buckle up, it's going to get hard. Instead of them saying that, they're saying, you're crazy to think that the economy isn't strong. Why are they lying to us, Mitch? Can you please make it make sense?
One thing that's absolutely clear is that no administration in history wants to create a panic when they don't have the solution. And this administration is doing what it can on what I would call top line revenue, which would be the tariffs, because it's large dollars and it helps balance our US national debt. That's the theory. The problem is that this does nothing for mom and pop. And Mr. Bessent was right in what he's saying. It's just not going far enough, because the world's largest purveyor of financial fraud is, in fact, the Federal Reserve. And it is the Federal Reserve that has caused the inflation in the stock market. It is the Federal Reserve, by virtue of causing the inflation in pricing, be it the stock market and all the goods associated with what is produced via the stock market, to affect mom and pop. Therefore, if you don't have the solution for the right hand, which is mom and pop, versus the left hand, which was what the Federal Reserve has done in the top line revenue that President Trump is trying to fix, you've got to have a solution over here. And we've denoted what that problem is. The answer is repeal the real estate tax in favor of the uniform state sales tax and restore the balance sheet of home ownership to mom and pop. There's no reason, and this is one point that Mr. Bessent is missing. Home ownership, for all intents and purposes, is dead. You've killed the American dream, not him, but what has happened in the last 6 years has killed the American dream. They've made it so expensive that people cannot afford a house, be it a first-time home buyer or somebody who's wanting to sell now owns a house, they realize what the new cost is, and they're saying, well, I can't afford to move. That kills the American dream of home ownership. We have the solution. There is a solution to this. The problem is we don't know what the federal government knows. What we do know is that we're doing the best we can to raise these issues in front of them, and they are apparently not doing what needs to be done yet, and that includes the SEC. We have the evidence. It's on our website. It's irrefutable. The courts have already admitted that fraud has occurred, but they need to hear it in order to put a floor and a ceiling on this problem. It can be fixed, but you can tell that Mr. Bessent is hedging his words carefully because no one wants to start a panic.
Yeah, but also we are winning as well. And there are additional solutions when it comes to local debt. And what I mean is bonds. Mitch, can you end us out of here with your final thoughts? And maybe you could talk to the viewers a little bit about the success that we had this week with conquering local debt. Now, I'll save them to the stories of the atrocious response from the bond thugs. But overall, can you articulate how refreshing that victory was, and how we did it? That's the important thing. How did we do it? Because it was a landslide. They had no chance of passing that bond debt. It was a landslide victory. I think it was the biggest blowout in the state
in history.
Talk to the viewers about how we did that and why that was important.
In Johnson County, it was like Travis said, a complete landslide, 100% shutdown of all the anticipated bonds to be raised. Doesn't mean they're not going to come back and try it again, but here's the underlying point. Isn't it interesting what you can accomplish when you tell the truth? And you tell the truth in a very local manner, such as using Facebook. So the Horse Barn Eliminate Property Tax Facebook page has grown dramatically. And Travis got involved and he started being rather verbose, and it worked. And then Greg Cooper was involved and he took it from the legislative side. A handful of people with no dollars on our side spent. Kayla was involved. Several people, just a handful of people, okay? No dollars spent on our side versus give or take 130,000 that they spent to promote propaganda and lie to the public. They got crushed. So the proof of concept of what we're saying exists. The goal is to reach mom and pop at the most basic local level and simply state the truth. We have the evidence at mockingbirdproperties.com/DCAD. It's on Travis's site, realestatemindset.org. It's on Jeff Mashburn's site with regard to the 313 agreements and the energy contracts, commonsenselaw.org. The evidence is irrefutable. It's not up for debate. It exists. We've got them on videotape, audio tape, their writings, their laws. We have it all. They have nothing but propaganda and lies, and they can be beat. You know, it's kind of funny. One of the people brought up, well, this is Rocky hitting Drago in the face and cutting him on the cheek. It's exactly what has happened here. They got cut. They're bleeding. And we're about to do something. There's something in the works right now. We'll see how far this goes. But you must realize when these school districts don't get these bonds, not only are they already bankrupt, but now there's justification, if they're not paying their bills, to put them into involuntary bankruptcy. There's things that can be done, but mom and pop need to be told the truth. And you get to the truth at this point quite simply. Go to your school district. We've published a list. It's on my website. It's on Travis's website. We've published a list of questions to ask your school district and your central appraisal district. In particular, on the school district, simply go and say, I want, via the Freedom of Information Act, all outstanding school district bonds totaled. And then I want to know exactly how much compound cumulative interest is outstanding as of today, totaled. Take those two numbers, add them up, divide it by the households in your community, and voila, what do you end up with? Well, maybe Argyle, at give or take 300,000 per house. Maybe Godly, Texas, at give or take 120,000 per house in fraudulent, outstanding school district bond debt. Now, in the case of Godly, the median home value is 160 grand. How would you like to wake up one morning, find out your 160 grand house is now saddled with a second mortgage you knew nothing about for $120,000? Well, do you realize in Salina, Texas, they just approved a bond, unlike Johnson County where they shot them all down. Salina gets approved, $1.5 billion against 9,000 houses. They literally put $257,000 per house on the existing houses in debt, and they did it in one fell swoop. They came out with massive advertising, all of which was a lie, none of it which is true. When these entities tell you, well, your taxes aren't going up, if you get a bond, your taxes aren't going up, there's not a stitch of math on this planet to back that statement up. They're lying to you. And again, they did so knowing full well they broke the law. They'll say, well, we're not supposed to tell you this, but we're telling you this over on this hand. That's a lie. That's a fraud.
Yeah. And it's sad. And it's tyranny, and it's bigotry, and it's happening every single day, every place, every county, it seems like every ISD. And so I just wanted to reiterate to the viewers my dream. Now, obviously, my dream is still to find a house of my dreams with wedge and with cash flow and to bring you through that. And I probably will do that in the next few months. My market is absolutely insane, guys. I live in Houston, so that's still my dream. But my other dream is to have a fully functioning advocacy that is designed to help mom and pop understand how to take back their local government. And you guys have already seen we have absolutely destroyed ARBs. We've got people $250,000 off by just using the math and the law. You guys are now seeing that we're also winning against the ISD boards. We have so much of the solution right now. So my dream is to come up with a mechanism to where it's easy for anyone to jump in any county to accomplish the things that we're accomplishing. But I got to tell you guys, right now we are in a great need for people to help us. So if you guys know anyone that can help us put all of this together, a website together, create the flyers, we have all of the information, but we don't have all of the time. Having said that, email us if you're willing to help. Visit the links in the description. Everything is for free and designed to empower you as mom and pop to take back control of your community. And having said that, you guys, we absolutely love you. Happy Friday. Have a great weekend. No video on Saturday, maybe a live video tomorrow. I don't know yet. Me and Mitch will talk about that. But either way, you guys, if you're out there investing in real estate, you guys know we wish you luck and we hope you win.